If you've been trading for any amount of time, you've seen charts plastered with order blocks. But here's the thing. What if I told you most of them are basically traps, just designed to take your money? Well, in this explainer, we're going to break down 3 simple golden rules to help you spot the real ones and just ignore all the fakes. So you've seen it, right? Those charts online covered in little boxes, people promising these insane returns. But the reality is, most of these setups are designed to fail. And they fail because they're missing the crucial context that separates a real institutional move from just random market noise. And right here, this is the core of the problem. We as traders see a shaded box and we immediately think it's a high probability signal. But the truth is, the vast majority of these are just noise. They're formed when volume is low, when the market's just chopping around. They simply don't have that smart money muscle behind them that gives a real order block its power. So how do we find the ones that actually work? Well, first things first, we need to know what we're really looking for. And it's not just about pretty candles, okay? It's about learning to spot the footprints of the big players, the institutions. Think of it like this. An order block isn't some random candle. It's a clue. It's a very specific area on your chart that basically screams, hey, right here. This is where the big institutions stepped in with huge market-moving orders. This is where they either load up on positions or get rid of them right before they send the price flying. And there are really only 2 types you need to be hunting for. You've got your bullish order block, which is the last down candle right before a powerful move up. That's the final moment of selling before the buyers just took complete control. Then you have the opposite, a bearish block. That's the last up candle before the price tanks. It's that last little gasp of buying before the sellers came in and took over. Okay, check this out. A perfect example of a bullish block. Do you see that little bit of consolidation right before that huge move? That's likely where the institutions were quietly accumulating their buy orders. And then, once they were ready, boom, the price just exploded, leaving that zone behind as a really powerful area of future support. And just to flip it, here's a beautiful bearish example. You can see the price rallies up to a peak and it forms that last little up candle. That's the distribution zone. That's where they were offloading their positions. And as soon as those sell orders were filled, the price broke down hard, turning that order block into a new ceiling, a really strong resistance level. All right, now we get to the absolute core of this whole strategy. These next 3 rules, honestly, this is what's going to separate you from the 90% of traders who get this wrong. These rules are designed to make you think like an institution, not like retail. So here's the most important part. For an order block to even get on your radar, it has to meet all 3 of these conditions. This is not a mix and match menu, okay? These rules are completely non-negotiable, and I promise you, they will save you from an incredible number of failed trades. Rule number 1, and this is by far the most important. The order block cannot exist in a vacuum. It has to be the direct cause of a major shift in the market's direction, or at the very least, a confirmation of the current trend. It has to actually mean something in the bigger story that the price is telling. And how do we validate this? We look for what's called a break of structure, or BOS. So when the price smashes through a previous swing high in an uptrend, that confirms the bulls are still in charge. The order block that fueled that specific move, that's the only one we care about. Now, what if the trend is about to reverse? For that, we look for a change of character, or CHOCH. This is your first major warning sign. So for example, in an uptrend, if price suddenly fails to make a new high and instead breaks the last low, the market's character has shifted. It's gone from bullish to potentially bearish. And the order block that caused that shift is absolutely critical. Okay, rule number 2. The move away from the order block has to be urgent. It has to be powerful. We call this displacement. It's a strong, decisive push that signals real institutional intent. It can't be a slow, choppy grind. You should literally see the power behind the move. It often even leaves behind an imbalance, like a fair value gap, where price moved so fast it didn't have time to trade properly. And finally, rule number 3. And listen, this rule alone will filter out almost all of the bad setups you see. An order block is like a fresh footprint in the sand. It is only valid the very first time price comes back to test it. If the price has already touched that zone, even with a tiny wick, it's considered mitigated. The institutional orders are probably gone, the edge is gone, the magic is gone. It's done. Okay, so let's put all 3 of these rules together into a super simple, repeatable trading plan. This is how you go from just knowing the theory to actually executing trades. So here's your 4-step framework. It's this simple. Step 1, you find that valid change in market structure, the BOS or CHOCH. Step 2, you find the exact unmitigated order block that launched that move. Step 3, you have to be patient and wait for the price to come back to your zone. And finally, step 4, you execute with your risk completely predefined. Let's look at this in practice. So here we can see the market is in a really clear uptrend. It has just created a break of structure by blowing past that previous high. What does that tell us? It tells us that institutional buyers are absolutely in control and they are actively pushing this market higher. So which order block do we trade? Do we trade all of them? No way. We trade the specific, unmitigated block that sits right at the base of that powerful move that caused the BOS. That is our golden zone. We mark it up on our chart, we set an alert, and we patiently wait for the price to pull back to us, giving us a super high probability entry. And this all brings us to what might be the most important takeaway from this entire explainer. Look, successful trading is not about finding more setups. It's about finding much, much better ones. It's quality over quantity every single time. Your job as a trader isn't to find every single box on the chart. Your job is to be an aggressive filter, a bouncer at a nightclub. Use this as your checklist. Did the move lack power? Is the zone already tested? Did it fail to break any real structure? If the answer is yes to any of these, you just move on. No hesitation, no exceptions. And you've got to remember this quote from Justin Bennett. It just nails it. Order blocks are not a magic bullet. They are just one piece of evidence in a much larger puzzle. The order block tells you where to look, but it's the market structure that tells you why you should even be looking in the first place. So the next time you open up your charts, I want you to ask yourself this one question. Are you just randomly drawing boxes on candles hoping one of them is going to work out? Or are you using these rules to actually read the story the market is telling you? The story of where the smart money is moving and why? Because that is the difference that really matters.